The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing?
And head fiduciary, right?
That's right.
That's right.
Senior fiduciary.
What's going on?
For those of you new to the show, we developed this show to answer your financial questions. If you have any financial questions or like to take advantage of our no cost, no obligation written retirement plan and or Social Security optimization program, don't hesitate to call us at 972-715-2424. Again, 972-715-2424, or you can always go to ilovemyretirement.com. All right. We always talk about things to do in retirement, how to get much income in retirement, stuff like that. So the first thing I want to start today is people a little younger. We're going to go the 9 steps to get early retirement so you can retire early. And some of this is from the Financial Word magazine, which is kind of interesting that it's a lot of the same stuff we talk about a lot. But if you're one of those people that want to retire early, remember, I'm the opposite. I never want to retire.
Now, wait a second.
I figure 75, 80, maybe I'll slow down a bit.
Hold on.
What?
I remember when we used to do seminars, and the KRLD seminar,
20
right?
years ago, yeah.
Yeah. You had a stack of these magazines, and you'd just throw them on the floor and say, forget about those magazines.
That's right. I said, don't get your investment advice from magazines.
That's right.
Most of them are paid for by mutual fund companies and stuff like that. That's absolutely true. You just got to be careful. If they're telling you what to buy, then I'm a little suspect. Because remember, they don't know you. A customer told me, he said, we're going to do your plan there, but my current advisor said they didn't think that was a great idea. And I was like, well, what did you think they were going to say? Let me help you fill out the paperwork to take the money out of my family's mouths? Of course they don't.
The problem is the magazines don't know enough about you to give you specific advice, and the philosophy they share, right, like what we're picking out of the magazine, is appropriate for some, but it may not be appropriate for all. And if the philosophy they're giving you matches perhaps what they might be selling, it's suspect.
Well, the one thing is weird is one of them was a do-it-yourself thing. It was I'm not going to mention the name of the company, but basically they're managing their own money,
right?
And they're saying we don't think this is a good idea. Now, I go, we've gone through hours and hours of research and analysis with you, gone over every piece of your financial condition. They know nothing about you, yet they're telling you what to or not to buy.
Exactly.
I go, all that is the conservation department doing what they're told to do. Keep accounts here. Don't let them go out anywhere. Whatever you got to do, do it. But the truth is, anybody that has the most recent information and is looking out for your objectives and something fills your objectives, that's probably the direction you need to go, and that's who you need to listen to. It doesn't matter. I used to hire a bunch of kids from the bigger firms. You always thought, well, the bigger firms, they don't know anything. Experience is everything. Anybody that tells you they've been doing something for 30 years and doesn't know more now than when they started, even 10 years into the business. That's why they always tell me, well, how much experience do you need? When I was younger, I couldn't say this, obviously, but I think 20 years.
Yep.
You need to have been through up cycles of the market, down cycles, high interest rates, low interest rates, and everything in between to really give rounded advice to an individual. You have to be licensed everywhere.
And all these wholesalers that comes to the large wirehouses that come to our firm, and they call you and they want you to carry their product, whether it's life settlements or whether it's a real good unit trust or whatever, they've got very good spiels. And if you're new and you don't know any better, I'm going to put all my clients in that. And until you do that a few times, until you've been down the road, you really don't know.
And most advisors you're ever going to talk to are pretty successful. These are, a lot of them, professional salesmen. They've been doing this a long time, and all of them are going to sound pretty good. You have to look out what's best for your interest, not what the salesman's interest or whatever. You got to kind of lead through. And that's why you find an advisor, like we pride ourselves on telling you everything. We don't tell you just the good. We're going to tell you the bad. What is the cons of this particular investment? Can I do better? Those are the kind of questions you ask. All right, what is my worst case? What's the negatives? All right, what if interest rates go up? Could I have done better with something else?
That's right.
What if the stock market goes up or down? Would I have done better with something else? The advisor has to be able to answer those kind of things to your satisfaction, not theirs. It's got to be to yours.
And I'll tell you a real good, quick situation that I'm sure you've heard of. You've heard these commercials all over the place talking about if you're looking at a fixed annuity, don't do it. Call me. I'll tell you why I hate fixed annuities, and it's very misleading. I mean, how many times have you talked to somebody that got in the stock market and it ruined their retirement? You don't tell people not to get in the stock market. The truth is, the fixed annuities that they're telling you not to do, and they go through a story about an older couple that needed their money and they couldn't get it, and it ruined their retirement. It pulls at your heartstrings. Well, the reason it's misleading, fixed annuities, you can stop that income stream. You can access your funds. You've got control of your money. Your heirs get it when you die. They're not telling you the whole story because it fits what they're promoting. That's what you got to watch out for.
I mean, remember, we love the stock market. We advise people in the stock market and have for decades.
But we could tell stories why you shouldn't do it,
That's
right? Just like annuities.
If you're not licensed and don't offer everything, you're just going to tell them to buy what you offer. Everything else is terrible. Only thing is good is what you offer. So then remember, you got to make sure an advisor has all the licenses, all the credentials, and most importantly, offers all the products. Because even if they have the license but only offer one product, trust me, every single thing will be in that product. Every single solution to every problem will be that one product. And not one product can't fit everyone. That is impossible. Anybody tells you stay out of the stock market, it's the worst thing, the only thing you should do is this, is not telling you the truth. All they're doing is trying to sell you something. And the same thing with the guys that just do, say, managed stock program. Everything else is bad except my managed stock program. Really? Mutual funds are bad, annuities are bad, bonds are bad, except my managed program. That's the only way to go. Well, that's not true. Okay? Don't get me wrong. There are some good managed programs out there. There's some good annuities out there, some good bonds out there. If you're okay with the 30-year municipal bond, some of the rates ain't bad tax-free. You just got to know that. And that's why you compare every possibility or every potential thing to the thing they're offering. Then you make a decision whether it's right or not right for you and your family. But they got to give you all the information. Even though we live in the information world, there are so many nuances to investments nowadays, much more than it used to be, that you really have to have a seasoned professional. Remember, if you'd like to take advantage of our no obligation, no cost, financial plan, retirement plan, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. All right.
Do you have some shortcuts for us?
How do you retire early? Early might be 75 to you, or it might be 45. It just depends. Or I know people, it might be 40.
I think I missed early.
Yeah. We both missed early a long time ago.
Damn it.
Now we're just hoping not to be 90, right?
I'm thinking 70.
All right. Number one thing to retiring early is know your finances. Doesn't matter which age you're talking about. The most important thing about retiring early is knowing how much money you need to retire and how much more money it will take to get there. And you have to have a solid written plan. It can't be something on a scratch pad. It's got to be written down. All right. Knowing your finances is the foundation for starting your investment and saving strategy. Knowing how to determine, you got to determine if you're going in the right direction. Or if you need to shift gears towards a better paying job or career, or start looking at ways to improve your financial position.
How to adjust it.
Right. Your current finances will also help you get a realistic goal in retirement. In other words, I've saved $100,000 and I'd like about $150,000 a year in retirement. Well, that's not a realistic goal if you're going to retire in a couple of years. It's impossible.
Now, if you're 20, it might work.
I hear this all the time. Well, I only have this many bills, but remember, you got to factor inflation into the mix. You've got to factor these things in because there's no way your water bill is going to be the same 20 years from now it is now. Not your electric bill, not your health care insurance.
Now, offsetting that, hopefully the house is paid for. Maybe the kids are through school, but there are going to be big draws on your income for 10-year, 15-year period of time, and you got to factor that all in.
Just like that, the Obamacare thing. Remember, it was supposed to lower premiums.
Oh yeah,
it was supposed to cost $1.34 trillion. So it had a good. In theory, it was good. We're trying to, get these last 10% people insured, but all they did was screw the other 90% over.
Well, and they snuck the money out of the government to pay the shortage, and now United's out of the deal because
they're getting out of there because they're cutting that payment.
Absolutely.
So the insurance companies are losing their shorts because what happened is there was that 10% of people, but most of those people weren't that healthy. So now they took on the most unhealthy, the most unprofitable part of the business, and so it's hurting the insurance company. So they're raising premiums like crazy.
They call that adverse selection, I believe.
That's exactly what it's called.
Yeah.
All right. Next, number 2 is to set your goals. Okay, you have to determine how much money you're going to require in retirement. If you know how much you need to live, you need to factor in inflation for it and all that stuff. Then you start with a plan once you know everything about your finances. And we got more when we return from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Today we're talking about how to retire early. What are the steps you need to take to retire early? The number one step is to know your finances. It's a really good idea to bring your spouse in on this. I know some of you fellas out there don't want to bring your spouse in, maybe some of you ladies too. But you need to bring everybody in and go over everything. You'd be shocked on what you'll find.
There's usually one spouse, male or female, doesn't matter, that really just doesn't want to invest the time in the deal. No. I mean, they care, but they just don't want to invest. No. I trust you, honey. It's up to you.
My wife goes, that's what you do for a living. What do I need to know?
Exactly.
Well, what if I croak?
What happens? That's right.
You're taking care of me, right? Well, I don't know if I can do that from the grave. I don't want you to be taken advantage of.
We'll take care of her, Victor. Don't you worry.
But remember, the foundation for retiring early and any kind of retirement, even if you retire on time, will be knowing your finances. You've got to have this stuff written down. It is essential to have a written plan. Okay?
I like the next one coming.
Then you got to set your goals. Remember, you got to set your goals. I want to retire here. How much income do I need? All that kind of stuff. You've got to know that. The next one is you got to be frugal. Remember, this is if you want to retire early. This is one thing that Guy and I have a problem with. I don't think 2 human beings in the world can spend more than we do. Doesn't seem like it, but I'm sure there is. It's very difficult for me not to. Amazon Prime is like a godsend sometimes. I really like it. 2 days free. It's crazy. I go on all the things. They go, you can get anything from Home Depot, Lowe's. You don't have to leave your house. It comes right to your house. Doesn't charge you anything. Amazing. But you got to be frugal if you want to retire early. Now, for those of you that are 40 years old and already saved $50 million, you can ignore this segment.
Come back for the third segment. No.
For the rest of us, to retire early takes a lot of discipline. Okay.
And if I can back up one on the goals, because we touched on a little bit in the last segment, and now we're going into this segment. One of the hardest things, we've got the retirement planner, the financial analysis that we do for folks, and we always talk about it. It's a great tool, and it shows when money comes out of your accounts and when it goes in and when the house is paid for and how long your money will last, at what age you'll be broke. But one of the hardest, it's got lots of questions we go through to get all these numbers right for you. But one of the hardest questions, Victor, that I come across with clients is how much are you going to need in retirement? We talked about the old rule used to be 80% of your paycheck is what you should get. They've kind of bumped that up to 100% now. But that's a hard question for most people to answer. So really give some thought to that, because that's your goal. If you know that number, if you're replacing your paycheck, then you just back into how much you have to save, how long you have to defer it, how frugal you have to be, which we just talked about.
I'll tell you what, we've been doing this for 30 years apiece, and I'd say 20% of the people that come to us have no idea what they spend a month. 20%.
It's true.
I would say the rest have some idea, and most of those are wrong once they actually write them down. Like they say, well, I'm only spending $6,000 a month, and I'll get a detailed sheet and it shows $10,000 a month coming out. You just don't know until you write it down, because what you got to do is you just don't. What they'll try to add is just their hard expenses. They got a mortgage, a car payment. They forget everything else. I go, what? You want the same lifestyle in retirement, or you want a worse one? Worse one. You got to have what you're spending now. Like take about 3 months, like thing I try to make it easy on myself. I put it all on those miles cards so I can upgrade to first class and get free airline tickets, right? Put everything on the miles.
We do the same.
So I know if I paid a $10,000 bill, I'm spending that at least a month, right? And you add the other stuff. And that'll talk about all your going, that'll account for all your going out to eat stuff or messing with the kids, grandkids, whatever.
And go ahead. We're looking at each other, don't know who should talk. Since you can't see us, I'll go ahead and ad lib that for you. The other thing, I hope I'm not cutting ahead. I haven't read the article that you're talking about, Victor, but the other thing that's really difficult for most clients to answer is what their account, especially their 401ks, but what their account's actually earning. Because money's going in constantly, weekly, monthly, and market's up, and they really don't know what it's earning or what the fees are.
And I'd say they're wrong about 90% of the time on that one.
Even engineers and stuff. It's crazy.
Now, what's the best way to be frugal? The best way that I've ever seen.
Take the credit card from your wife?
Yeah. Throw all the credit cards away. No, the best thing I've ever seen, and that was sexist guy.
Me and Trump, right?
The best thing I've ever seen is to write down everything you spend. It seems like an easy. I guarantee, I better not say the SEC, I promise you, if you write down everything you spend, you will spend less. Yeah. Because you're like, oh my gosh, I didn't know I was spending this much. There's some apps. There's a lot of apps that do it. I know it seems like a hassle, but it's really not that big a deal. You spend $4.99 on something, just put it in there, and you'll be shocked midweek how much you spent. But it will make you cognizant of what you're spending, so you will automatically spend less because you don't want this app to keep going up.
You get tired of writing it down. Yeah, I'm not going to spend it because I don't want to enter it.
And I'm telling you, every time there can't be $1 that goes out that you don't put on there. If you do that, I promise you will spend less money. I don't care who you are. I've never seen anybody that did it that did not spend less money.
It'll show you where the pork is or where the fat is.
And it usually, a lot of people that, spent, like in my neighborhood, they'll do it and they'll be shocked how much they spend. I didn't think I spent anywhere near that. I know. When you're just adding your hard expenses together, you don't realize how much soft expenses are.
Oh, yeah.
They're way more in my family, way more than the hard expenses. And remember, if you'd like to take advantage of our retirement plan, we could do this stuff for you in a lot of ways.
We'd like to show you.
Yeah, we have to provide you. You have to provide us some information. We'll put in things, and it'll show you if you can retire early. We still have a few more steps here on the 9 steps to retiring early, but don't hesitate to call us. We'd be more than happy to help you with this. 972-715-2424. Again, 972-715-2424. You can always go to ilovemyretirement.com. The next step we're going to talk about after the break is getting rid of debt. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today we're talking about the 9 steps to retire early. Early could mean 40 to you, 50, 60, or 70.
70's not early.
The average retirement age in the last 20 years has gone from 60 to 70.
Well, we're living longer. It makes sense, right?
Well, remember, in the old days, you worked at a company 20, 30 years, you retired. And it could be in your 40s or 50s.
Because one big reason?
Pension.
You got a pension. You added something that replaced your paycheck.
That's right. Okay, remember, know your finances. With number 1 foundation, you have to know your finances. You have to set your goals. Okay? You have to be frugal. I know this is a tough one for me especially. Spending less. Best way to spend less, write everything down. That's the best advice I could ever give you if you want to spend less. Just write everything you spend down. There's apps that do it, and that will automatically make you spend less money.
Yeah, and if you just do it for a month, it'll give you an outline of what you need to do.
Get rid of your debt.
Here we go.
I'm with Dave Ramsey and the rest of them on this one. You have to get rid of debt. This is hard. Really hard.
Susie Orman, you always do pay the small ones off first. Yep. Gives you more cash flow for the big ones. Right. It cascades. It snowballs. Get rid of the debt.
Plus, you can get rid of one completely.
Yep.
The one thing is, I'll tell you, if you're going to pay off those debts, don't do it and run them back up. That happens most of the time, actually.
How many times you hear these mortgage companies talk about get a second, clear off your debt? Yep. Well, if you have the propensity to run up debt, and now you have a second on your house and your debt's clear, what are you going to do? You're going to run it up again. Don't do that.
There's study after study has shown if you will work on it, just really concentrate and paying off debt, it only takes 1 to 2 years.
Don't do it by getting a second on your house.
That's just more debt. That's just rearranging debt.
Exactly.
It is lower interest rate.
That's the pitch. Yeah, lower interest rate.
And
Don't
you can
do it.
write it off, and all that kind of stuff. But stay out of debt is the biggest thing. I'll argue with accountants to this day. They say, don't pay off your mortgage. It's your last write-off. The peace of mind knowing that house is yours is worth way more than a tax write-off, especially as your mortgage gets lower. The write-off is negligible later on. It is bigger at the beginning, no question. But the peace of mind knowing that house is paid off is it. It's just like we talked about the peace of mind knowing your bills are paid. That's why we are big proponents of having a guaranteed income stream to pay all of your bills. Then you do the stock market is the greatest place in the world to help fight inflation later and all that, but you're not using the stock market to pay bills because the stock market goes down, your bills aren't going to stop coming. Or dividends go down, interest rates go down, your bills are going to keep coming and they're going to keep going up. So you need a steady income stream, preferably an income stream that will go up with inflation. And that would even be better.
And ideally, you need to have the funds tucked away, and I'll say a fixed annuity, bonds, whatever. For that, it's a stable income stream, and you need to have the stocks. They're an inflation hedge. But when you have your hard costs, you have your bills taken care of, you've got a paycheck replacement, if you will, an income stream, you're not stressing over the stock market part of it. Hopefully you've been judicious, you've got it in a nice index or something, and it's doing what it's supposed to do, but it's going to go down. It always does. But if that's where all your money is, you're going to have a propensity to want to take it out. And if you've got that income stream, it's just easier to let it ride when you have to.
Just forget any sales pitch, anything. Just think logically.
Exactly.
Let's say you're making $10,000 a month, and you got $10,000 a month coming for the rest of your life. How scared are you of your retirement? Are you pretty happy, right?
Absolutely.
That's going to be a happy retirement. Now let's say that goes down to just Social Security at $2,000 a month. A little apprehensive now?
Absolutely.
That's what we do. Make sure the bills are paid with a steady, guaranteed income stream till you die.
That gives a whole
Then you put the other stuff in the stock market and all that kind of stuff.
If you go from 10 to 2, that gives a whole new meaning to frugal.
Yeah, you better be frugal, right?
Exactly.
And remember, we can put a plan like that together, or you can just talk to us and we'll show you how it works. 972-715-2424. 972-715-2424, or go to ilovemyretirement.com. All right, we're on step number 5. This is 9 steps to an early retirement. Keep those big expenses at bay. Here's the issue I've got. Quit buying new houses and no more boats. No more
You got rid of the boats?
I did. The boat's a money pit. My wife is still mad about getting rid of the boat.
We've had, my wife and I've had boats our whole life, except for now. And the only people I hear say boats are a money pit are not truly boaters.
I'm not a boater now. Don't you remember, Guy? We used to spend 12, 14 hours on the lake, right? In the middle of the hot sun.
Oh, yeah.
I don't even think I used suntan lotion or whatever.
Soaking in the water on a float.
What about at our age, 1 hour? And I'm like,
and we're not that old, but
yeah. This is
your
too hot. Let's get out of here.
Your priorities change, don't they?
I'm under the thing, and it's still too hot under the shade.
I know.
Somebody needs to do something here.
Priorities change.
All right.
I had that conversation with my mom this weekend. Said, when I was younger, the things that I really wanted to do, I knew I was going to always do.
Oh, yeah.
No, not so much.
No.
My priorities have changed.
I'm afraid I'm going to look really old with craggly skin, too. I don't want to do it. Number 6, needs versus wants. This is a tough one. The lines are usually blurred. I knew I needed a new car a few months ago. Not really, right?
You had 170,000 miles on your old one, didn't you?
200,000 miles.
There you go.
I keep my cars forever. 200, 300,000 miles.
You did good. Absolutely.
But, hey, you got to determine your needs versus your wants. This is if you want to retire early. And we got more coming up, folks, but we got a break. Remember, don't hesitate to call us if you have any financial questions. 972-715-2424. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. Today we're talking about how to retire early. Usually we're talking about stuff to do in retirement. We're talking today about how to get there early.
And if not early, definitely securely when you get there, because a lot of us are probably going to work to 70 anyway, right? Not because you couldn't retire at 60 or 65, but What are you going to do?
You watch, guy. This winning lottery ticket in my pocket here, I'm still going to be here.
You haven't checked your numbers yet?
I know it's a winner.
There you go.
Cancel my appointments on Monday. I'm going to Austin.
Is that your 401k? You contribute to your 401k again, buy a ticket.
All right. Remember, know your finances. Number one rule. Number one, you have to know your finances. That's why it's so important to have our written retirement plan. There's no cost or obligation to it, but it'll show you what your life looks like at 50, 60, 70, 80, and beyond. It'll show you what happens if inflation hits. What happens if my stocks or my investments don't perform very well? What happens if one of the spouse passes away? In other words, one of the Social Security goes away. Does one of the pensions go away? Or you got to have that all in writing to really know. That's number one. You got to set your goals.
Know how much you're going to need in retirement. Paycheck replacement.
You got to be frugal. Number one way to be frugal, write down everything you spend. Write it down. There's apps for it, and they're fantastic apps, and they will make you spend less.
And you don't have to do it for the rest of your life just to get a handle on things.
And everybody knows this. It's just like a blah, blah, blah. Get out of debt. Oh, of course you get out of debt. That's easy, right? Get out of debt is another one. Debt is a killer.
That's right. How many people do you know that get a 30-year mortgage on their house, but they're going to make that extra payment so that it's paid off in 15 years or 10 years?
Everybody.
Never happens.
I'm getting around to it. It's only been like 14 years.
Exactly.
Keep those big expenses at bay. Maybe you don't need a new boat every once in a while. Don't need a bigger house.
Golf cart.
Man, remember I grew up in Preston Hollow. It's probably about a 1,500 square foot house. Now the lots are selling for like $1 million.
Yeah, it wasn't like Preston Hollow today.
No, but that was a decent house. I remember my dad had like a 2,800 square foot, and it was like, to me, a mansion, gigantic. Now you've been looking at houses lately. Small ones are 3,000. They're 4,000 to 6,000 square feet everywhere. It's crazy.
In the 80s, 3,500 was the biggest house.
I mean, big house.
It was a big house. What happened? No. Theater rooms, exercise rooms. Oh, my God.
Now somebody goes, 3,000? Well, that's small, right? No, that's a big house. Your needs versus your wants. This has always been aligned with me. Like, I always need a new power tool.
And you can rationalize. It'll save me money if I buy this.
That's right.
I can't afford not to.
I won't have to go to the store when I need to cut that tile. You've never cut tile in your life. I might be changing tile in the bathroom. You never know.
Yeah, I got to rent it. I got to buy. I'll buy it.
My wife told me the other day, goes, there's 2 or 3 power things still in the box in your garage. They're ready for when I do that project.
Isn't life great?
I got this really new rotary thing.
Or as Tim Allen would say, ho, ho, ho.
I love power tools. All right. The next thing, remember that budget. Number 7 out of 9 is qualified retirement plan. You've heard us saying this a lot.
You sure went through the budget pretty quick. Are you budget adverse?
Retirement plan is people don't realize. Anybody tells you, I hear this all the time, but it's usually some person that's just insurance licensed or somebody that's they're selling private investments, garbage like that. Anything's private's bad. They lose it. How long we've been doing this? 30 years. They lose 90% of the time.
Yeah, and I hate to hear a blanket statement because there's always an exception.
There is.
Boy, that one you can almost have a blanket statement on.
What's the hottest private investment now? REITs, private REITs.
Oh yeah.
I got people stuck in those. They were told they're getting this. The value's a tenth of what it was. They were getting paid a tenth of what, and they were promised huge returns on this REIT.
I've got clients that have come in and asked me to check them out for them, and you call the sales guys. Aside from them trying to sell you on the fact that you got to sell their REIT once they find out you're an advisor in town, they always have a story because they've got a lot of clients that are all invested in this. And what do they want to know? They want to know when it's liquid. When can I access some money? When can I make a withdrawal? Good news on these REITs, we've talked about it before, they offer like 7 or 8% interest, and you'll get that. They pay the interest, usually right on time, but you can't liquidate it because there's not a market for that until they go public and they sell it. So you call and you ask, well, when can I make a withdrawal more than my 7%? When it can be liquid? And they always have an answer. Well, we've got so-and-so, so-and-so, and so-and-so looking at it. And we may be able to go public, towards the end of the year or beginning of next. They've always got that.
I've got them where they started with 7%. They're still getting the same income, but they've raised the management fees so they're getting 1 or 2%.
Yeah, the net is not
Remember,
7%.
It's private investments.
Say that again. Most people don't catch that.
They'll start at 7, but they'll get your fees up to where you're only getting 1 or 2.
Exactly.
They'll lower the value because of those fees, because nobody wants to buy something with 1 or 2. So if you tried to sell it, you're going to get a third or fourth of what you bought it for. all private investments, like I said, most of the time bad. I've got a friend of mine that got into a real estate deal. He goes, Victor, you don't understand. I knew this guy in high school.
I know who this is.
He's got more money than you. You don't know what you're talking about.
Yeah.
He's letting me into a deal. He normally doesn't let people
couldn't get into it if I didn't know him.
That's right. It's a screw job. I always tell people, anytime somebody tells you I don't normally let people in, but I'll let you in this one time because you're an old buddy, is so full of it. You need to not walk out the door. You need to run. But qualified retirement plan, go back to the original step.
Well, but the end of that story is his money's in it and he's got no access to it, correct?
You can't get it out. It's been 10 years now.
Yeah.
But the qualified retirement, that's your 401ks. All right, your 403bs, your all that stuff. Those is almost impossible to grow money faster. I understand some of your 401ks or whatever might have a horrible choices.
List of options.
Even then, even if you don't even get a match, the tax deductibility part, the tax deferment part, it is almost impossible to save money faster than a 401k.
And if you want to, I know we're running out of time here. If you want to cut fees on your 401k and you've got bad choices, just look for an S&P 500 index. Warren Buffett recommends his wife do that when he's gone, and that'll make it easier. It'll save you on fees.
401ks, I think indexes are the way to go. All my 401ks and indexes, and I think most people's 401ks, if you have those options, should be in there. We have a break coming up, folks. Remember, if you have any questions, call us at 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome to the show. Welcome back to the show. All right, we're talking about how to retire early. We've already said you got to know your finances. Number one thing for a foundation is to know what you're doing. It can't be just off the top of your head. It's got to be written down, and then you and your spouse go over this stuff. All right, you got to set your goals. If you want to retire early, set a number. You got to know what kind of expenses you have.
How much income are you going to need?
Don't just use your hard expenses. Use what you're spending. And the easiest way to know what you're spending and to reduce it is to have an app or to write down everything you spend. You got to be frugal if you're going to retire early, unless you're that guy that has $50 million when you're 35 years
old. And a shortcut if you don't want to do the app route or you want to go backwards is you just tally up, obviously, your checking account and your credit cards, and you can probably get there.
Right. Get rid of your debt. Yep, me and Dave Ramsey are right on board with that. Keep the big expenses at bay. Try not to upgrade your house every 5 years. If you knew how many people over 70 buy brand new 30-year mortgages, you'd be shocked. Lots of them.
Over 70?
Yes, lots of them.
I would be shocked.
Your needs versus your wants. You have to determine, all right, what do we need versus what we want? Remember when you were a kid, a want would be a candy bar. A need would be shelter, clothing, food. I guess a candy bar could be food, couldn't it?
Well, let's see. It's got eggs, milk.
I told my kids, I said, yeah, my dad used to give us a quarter. We go to Doherty's Drugs. We live right behind that on Preston and Royal. And you could get a Coke and a candy bar for a quarter. He goes, oh, my God, you're 100 years old. Next story. Don't talk to these terrible children.
Who told you that?
Your
son?
Yeah. He goes, how old are you? I'm like, I guess pretty old. Yes, the gas station right there at the corner of Preston and Royal. It was like 32 cents a gallon, too. And they cleaned your windshield. They did everything, boy.
I paid a quarter in my mini bike when I was a kid, my motorcycle.
I know the younger people listening now like, oh, that's all I need to hear is two old guys talking about 30-cent gas. The qualified retirement plan, it is important to take advantage fully. If you can afford it, max out that 401k. And what is it, $18,000 a year if you're under 50? $24,000 a year if you are, plus the company matches and all that are on top of that.
Yeah, I had that question just the other day. Oh, I don't want to do that because the company match is going to be, you can put in, if you're over 50, 24. Yep. The company goes over and above that.
Yeah, the company can add up to 50, I believe.
It doesn't restrict your 24.
That's right. You got to put that in.
Depending on your age.
All right. These two last ones I'm going to go over quickly because they don't give up. Even if you're a little behind, just keep making changes and corrections to your plan, adjust your plan, but don't give up on it. And the last one was follow your passion. It's amazing to me how life can be really short if you're having a good time, It's
Twain.
Really long
if you're having a bad time. That's right. Mark Twain, what is it he used to say? If if you love your job, you never work a day in your life.
That's
Or if
right.
you love what you do, you never work a day in your life. Something.
Will
to that
Rogers
effect.
or one of them?
I think it was Mark Twain. I'm gonna
You're
go with
probably
that.
right.
I'm gonna go with that. Fact check.
I don't know, so I'm gonna have to agree with you. I
Fact
don't know.
checker.
I think it's all of these things lead to, if you want to retire early, you want to retire on time, you have to have a written retirement plan. There's been a study just came out. Only 16 people have a written retirement plan. 16%. I mean,
16 out of 100.
people.
Absolutely.
16 people out of 300 million. No, 16%. The number one goal of this retirement. That's what we offer this.
And they're all our clients.
That's right. We offer it at no charge, no obligation. Nobody's going to high pressure you. All right. But the number one goal of a written retirement plan is to ensure you can maintain your lifestyle for the rest of your life. That's what it is. You want to maintain that. Individuals that have a retirement plan are more likely to manage risk effectively. It boosts your confidence and feelings of security by reducing your stress and anxiety regarding retirement. Remember what I said? If you're making 10 grand a month now and you retire and are still making 10 grand a month, like a retirement paycheck, you're pretty happy. You're not scared about retiring because you know I just got the same check coming in, or, plenty to pay the bills anyway, right? If you have a good retirement plan, it can identify problem areas so you can effectively put a strategy together and implement that strategy to take care of that problem. You won't know until you actually wrote down those finances and put it into an actual plan. All right. You have a better understanding of your retirement needs because you've actually spent some time on it. What happens is people spend, I think, 5 times more time individually planning for a vacation than they do their entire retirement. Something they're going to live on for 30 years or more.
Yeah, and we'd like to have the opportunity to do it for you. There's never any obligation, but we would love to have the opportunity to earn your business. We can show you exactly how long your money will last if you change some things and adjust it and fine-tune it.
And as you're getting closer to retirement or in retirement, we adjust it based on the conditions that we change.
Absolutely.
Our number 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. They can also help you provide valuable insight in how inflation affects your portfolio over time. Even 2% inflation, which is very low, will have a significant effect on your retirement over time. It also help you provide for long-term care needs. It's amazing. We all have homeowners insurance. It's about a 1 out of 100 shot something happens to your house, like a house burning down. It's 1 out of 2 that you need a long-term care. It can show you what happens to your portfolio expenses if one of your spouses passes away or goes into a serious illness. It can address estate planning, charitable gift giving, and so on. Individuals with a written retirement plan are much more likely to achieve their objectives than not having a written retirement plan at all. It is imperative to all my listeners out there. You can listen to all the rhetoric of all the other radio shows and everything else. They're going to tell you to buy this, buy that, come to my seminar, come to this seminar. Having a written retirement plan is more important than all of that.
And
you can skip those free dinners that I get those things. I guess I'm over 50 with that. I get those. Skip all that. Get a written retirement plan. It will help you. If you manage your own finances, it will help you. Remember, our number is 972-715-2424. Again, 972-715-2424. You can go to ilovemyretirement.com. I'm Victor McClure for Guy Allard.
I wish you were Guy Allard.
We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice